Welcome to the FarrCast, kicking off our 7th season of giving you insight into Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. But here we are, Season 7, ladies and gentlemen. October the 4th. We're recording a little early this week, but we've got a lot of breaking news, of course. We've got the 10-year Treasury yield busting through the roof, going right through the roof, folks. It doesn't sound like a lot, but 480 on the 10-year and even a good deal higher print overnight is making a lot of folks nervous, particularly those folks who are thinking about a mortgage, as mortgage rates are now pushing up towards 8% for a mortgage. Wow, we're back to where my buddies and I were when we were taking our first mortgages. I got a great rate on my first mortgage, folks, 8.6%, and I fought to get one that low, 8.6%. It is having a headwind effect, but as you look at other economic data, the U.S. economy and the U.S. consumer have been resilient. Speaker of the House lost his job yesterday, first time they've ever booted somebody out like this. Some folks say that he made a deal he couldn't keep, he couldn't promise. Actually, maybe he kept his promise to the American people. I'm not sure, but he averted a shutdown at the expense of his job. Don't seem too many politicians vote for anything at the expense of their jobs. Of course, he remains a representative and a congressman. I've also met with a junior senator and a senior senator in the past 2 days. Both sort of suggest that it's a mess. They're shaking their heads. The senior senator, though, told me one thing, and we're going to talk with Mahaffee about this morning. It said that he has drafted a 14-month spending plan that he thinks he can get through for the Ukraine, equal monthly installments for the next 14 months to take us past the election, to take it as no longer a political issue for funding of Ukraine. Seemed like a reasonable plan. We'll see whether that gets through or not. He says that's going to get through, but I've never talked to a senator or a congressman who ever had a bill who didn't think they'd get it through. So take that as you will. Markets have been falling, and that's what they do in September. Typically, that's what they did. They didn't like yesterday. They went down a lot yesterday. Everything was down over 1% yesterday. Do we have a new trend? Is this the beginning of the pullback? Are we going to see a bear market? Is the recession coming finally? That recession that's always been 6 months away, is it now really 6 months away? Jim Iuorio, of course, is our wonderful friend from Chicago, as the head of TJM Institutional Services, a partner there, the voice, really, of the Chicago Exchange and the voice of wisdom here on the FarrCast. Welcome back, Jim.
Thank you, Michael.
We're glad you're here. Well, what do you make of all of this mess? And you were looking, I know, for higher levels from the S&P so far this year if we broke out or broke down. What are you seeing now? Have we broken down, and where do we go from here?
There's really only one story right now, and that's the dramatic rise in long-end rates. So you have to kind of break apart of why that's happening before you get a further outlook. So the question is the market finally believing the Fed and the higher for longer stuff? Is that, the Fed in the September 20th meeting, they increased their dot plot from 4.6 to 5.1, meaning they predict Fed funds rate in 2024 to be 5.1, much higher than previously thought. So the market seems to believe that. I personally think it's a combination of that and the fact that the M2 money supply is being contracted at the same time government issuance continues to grow. The government continues to sell massive amounts of bonds because they're profligate spenders. I don't think there's any real argument against that, and that's pushing long-term rates up. The third thing is that if you're in the stagflation camp, and all of a sudden you see the president walking with the UAW saying that 40% pay raises seems reasonable. You see 75,000 Kaiser Permanente workers threatening to strike, or maybe even having struck by now, for higher wages. When wages start to jump into the inflation picture, particularly union wages, and I know there's not nearly as many union members as there used to be, that can be the stickiest part of the wage price spiral. So it's all pretty daunting. So I don't think there's much. And when I was on with our good friend Larry Kudlow and Pete Najarian on Monday on Larry's show, and Pete talked about utilities and saying, yeah, they're rate sensitive. And my point was, everything is rate sensitive when rates are shooting through the roof like they are. So if there's right now, there's very little place to hide until we figure out how far rates are going to go up. I personally think that 5% is my target and probably limit on the 10-year. And until that happens and fulfills itself, I'm not really interested in any part of the stock market. If I had to pick any part of the stock market, I'd say maybe energy still looks reasonable, and maybe healthcare seemed to bottom relatively quickly too. And it seems like a place maybe to hide out. Does any of that make any sense? Or am I rambling on this early morning?
I'd say both. Yeah, a lot of it made sense, and there's a little rambling in there early in the morning, but it's good rambling. It's rambling from which we can learn a few things. For the yield curve to return to normal, which it will in time, one of two things has to happen. The 10-year yield has to go above the 2-year yield, or the 2-year yield has to go lower. I hope everybody's with me on that. There are only two ways out of this inverted yield curve. One of those two things can happen. So Fed is sitting there saying higher for longer, and the part that they control is that short-term rate, and they're already at 5.25%. Doesn't the 10-year Treasury kind of have to go above 5.25?
So here's what generally happens in the past, and I'm not necessarily saying this is going to happen presently. But usually, so the yield curve you mentioned that it went down to a negative 110 basis points, which was the deepest in 40 years. Also, the longest time period, I believe, was 18 months. Longest time period it stayed inverted in 40 years. The depth of the inversion and the length of the inversion does not usually correspond with the depth of the recession that it's predicting, but it does somewhat correspond to the surety of the recession that it's predicting, which I think is going to happen. Now, in the past, when that yield curve started to return to normal, and you talked about the fact that long end bonds are getting hit, meaning 10-year yields, 30-year yields are going higher, but 2-year yields are going higher too. They're just going higher much slowly. But the worst thing now that can happen is all of a sudden, if something breaks, like notice that the financial sector, the banks are not, usually they like rates going higher and they like a curve steepening. They're getting hit quite a bit too, because the rapidity of the move in rates might affect their balance sheet. And we don't know what every bank is holding, and perhaps there's still some of those problems that existed back in March. Stay with me because there is going to be an answer. So when the last part of the return to normal of the yield curve is usually that something's breaking in the economy from rates held too long, and the Fed then has to pivot real quickly and lower, forcefully, manually lower short end rates. And that's like the last move generally of the return to normal of the curve. And that tends to correspond with the biggest move lower in the stocks. This is a complicated issue. I know that, and I hate to go too deep into the weeds. And I know I oftentimes say, does that make sense? But this time I actually really mean it. Did that make sense?
Yeah, I think it made sense. There are a couple of things though that you threw in there. That was a lot there. You talked about the inevitability of recession given the inversion of the yield curve, and there are other historical indicators that also all indicate recession. You think we're going to have a recession then?
I don't think there's any doubt in my mind that we're going to have a recession sometime within the next 2 quarters. I think the reason it's been the illusion that we've avoided recession is because there was so much money pumped into the system, $7 trillion, which was probably, let's call it $4 trillion ahead of schedule for the COVID relief. 2 trillion of that was taken out, 2.5 trillion. There's still a lot of money that's left in the system. And that money left in the system is to the top 25% of the people. That's who holds it right now. They're spending, they're traveling. They're making it appear that things are fine when the lower 75% is really suffering with inflation, with higher borrowing costs. I think the Fed raising the rates the way that they did, the most interesting part of it is that every time is a little bit different. This time, the 5 years prior to the Fed's first rate hike, 10-year yields averaged under 2%, 1.96% for 10-year yields, meaning that there was a 5-year window that all the borrowers could roll into low rate duration. So then all of a sudden the Fed starts raising rates. Well, there's 80% of the people got the loans they wanted. Think in terms of mortgage. If you have your 3% mortgage, you're going to sit back and go, oh, you got to borrow money now? Sucks to be you. I'm fine. I still have my 3% mortgage. So the punch of these rates isn't going to be felt till further on. We always say like, oh, between 6 and 18 months is when the true punch of raising rates is felt by the economy. This time it's longer because of the fact that businesses and people were allowed to roll into duration and had a long time to do so.
So yes, it's 6 months away.
So I think it's less than 6 months. I think the recession will come around the year's turn.
Okay, so we still need for the NABR to actually call a recession. You and I would still look for a couple of quarters in a row of contraction, and we're still seeing expansion in GDP. Mm-hmm. So I feel like we're running out of runway for them to be calling quarters. It doesn't look like it's going to be the third quarter, so we've got at least 2 quarters before they call it anyway. I mean, even though we could be in recession in the first quarter, they're not going to call a recession. Sometimes they'll tell you the recession is over. We had one, and they'll tell you afterwards, and it would be a very short one. Somewhere in here, folks, I'm telling you, I agree with Jim Iuorio. Ken Polcari will say the same thing. Barugian says the same thing. You get anybody with white hair. Sorry, Iuorio, you really don't have any. We've been doing this, all of us, over 30 years. And there's something to Malcolm Gladwell's Blink. You know what? If you didn't read Blink by Malcolm Gladwell, go ahead and read it. It's a terrific concept. It's a great idea. Malcolm Gladwell's Blink is I think, an important book. So, and basically what he says in Blink is we tend not to trust our impressions if we can't put words to them. Friday, I looked at Friday's markets, and on our firm-wide call Friday, when the futures went up through the roof on Friday and everything was up strong in the morning, Jim, I said, I don't have a feeling that this is going to hold at all today. This doesn't feel real. I wouldn't be surprised, and I can't tell you why I'm saying this, but that happens often, right? You and I will look at a market, you and I look at a yield, you and I look at prices and say, that's not right. And if you ask me why, I just sit there and go, it's just not right. I can't, and I'm articulate, reasonably, and I can't. So when you get a group like, you've got to listen to us, folks. I'm telling you now, it's not going to be the end of the world, but Jim's right. So we could have that higher end yield, just to close the loop here, go up a bit. And then at some point, the Fed could lower the other end. So both directions, the 10-year yield could drift a bit higher, which Jim is suggesting it will. And I agree with him. And I think we could get over 5, maybe 5.15. I don't know why I'm saying that either, but that feels in the range. And then, yes, the Fed could step in and lower. But when the Fed lowers, it's because everything is really bad. Things have stopped. The economy needs that help. So that's not necessarily a good thing. That'll present some opportunities for stock prices. Jim, we're out of time. And we've covered some really good economic stuff here. Can you do a big circle back for us and tell me what you think this means to your technical indicators, what this means to you about where you think we end the year for the S&P? Give us some stock news.
Sure. I every time we go lower in the stock market, I sell, and I had some if people who follow me know I had some pretty decent option hedges on. I'm selling the 3,800 puts, the 4,000 puts in the S&P. To me, that seems like a reasonable base to work off of. Let's call it 4,000, because again, I don't think it's the end of the world either. I think when you said it looks like a fake, I think what you're seeing is that there's complacency in the market. So market positioning occasionally forces a trimming of the hedges. Plus the fact that if we are really to believe that rates are staying higher for longer, then you need to reevaluate everything else, because everything must be valued in terms of relative value against interest rates. So if we are to believe that, and I am to believe it for the short term, then the stocks have to go lower. I did say the 2 sectors that I dislike the least, is energy still. I think there will be a pullback in energy, but I do think that energy companies and oil are going to do better. And I think healthcare has probably been played out. I want to do metals, but I need to see the Fed say something dovish for me to flip into metals. But as soon as they do, I will increase my positions.
Jim Iuorio, partner at TJM Institutional Services, has been doing this for a long time. Our great friend. Thanks so much, Jim. We always learn so much when we get to talk to you. All right, pal.
See you soon.
Coming up, Dan Mahaffee, and then Bryn Talkington is coming up with us. We're going to see what Bryn thinks about all of this news, all of this noise, and what it means for stocks. Segment 3 of the FarrCast as we cover Wall Street, Washington, and the world. Please stay with us in Season 7.
Thank you for joining us this week on the FarrCast. Now it's time for political analyst Dan Mahaffee and your host, Michael Farr.
Welcome back. Joining us now, Series 7, Dan Mahaffee from the Center for the Study of the Presidency and Congress, and our senior political analyst on the FarrCast. 7 years ago, we said, are we going to have something political to talk about each and every week?
Yeah. Heck of a week, Michael, and it's already Wednesday morning.
It's been a heck of a month, and it's already Wednesday morning. Phew, wow. All right. Speaker of the House. Another one bites the dust for the first time, huh? For the first time.
Yeah,
ever.
First time. And look,
Tell us what happened here. Dan, what happened?
All right, we go back to the very opening days of the McCarthy speakership and the deal he made on this one-person motion to vacate, the MTV as we know it, and not the MTV of my childhood.
No,
but this was Chekhov's MTV because it sat there from the very beginning, looming over his head on first the debt ceiling deal, and now when we talked about, and last week when I was saying it was likely there would be some kind of shutdown absent what I called the McCarthy miracle. Well, look, he did that. He did break the glass. He did go ahead for something like that, but this was a Old Testament miracle, so it needed some kind of sacrifice, and that's Kevin McCarthy losing the speakership this week.
And he did he do the right thing? Did he do the right thing for the country by saying, I'm going to reach across the aisle and see if I can pull this off? I mean,
look, he did a right thing in saying, look, we needed to keep the government open. I think he acknowledged that. But I think he was also far more motivated by the fact that this would have been a mess laid squarely at the feet of Republicans before an election year, that any kind of shutdown would have just been reflective of the mess. So look, he got a deal to punt this at least until Thanksgiving, but we don't see a clear path yet on who his replacement's going to be, and that might not be until next week as the Republican conference sorts this out amongst themselves. So look, did he do the right thing keeping the government open? Yes. I don't think the motive, though, was to be a great example of statesmanship. I think he was, one, looking at the political cost of a shutdown, and two, daring these opponents to throw him out. I think his last best hope would have been...
Question answered.
Yeah, his last best hope would have been to try and get Democrats to support him on this vote. Talks like that would have looked something more like a European coalition government more than the U.S. Congress. Would you split the rules committee? Would you change the committee allotments? And look, all that stuff is sort of a political science, West Wing script, fun story. But the House really just doesn't work that way anymore, and the rules aren't even structured to allow that. So I don't think they would have been able to move in time. And then among Democrats, both Kevin McCarthy as a person, as well as what they saw with the impeachment, among Democrats, there's little appetite to help Republicans solve their own civil war.
They're almost sort of giggling, aren't they? Democrats watching the Republicans do this to themselves.
Yeah, I think they're giggling, and I think you have Senate Republicans looking on, in sort of shock and horror about what, with, again, these things looming. And also, again, your priorities. Getting rid of Kevin McCarthy does nothing to fix the debt or deficits. It does nothing about the Americans dying of fentanyl. It does nothing about our border. And it does nothing about the war in Ukraine or the threat from China. So the senators are shaking their heads. We have 45 days. We don't have spending plans yet through. The House is leaderless except for a speaker in name only, pro tem. And I think the quote goes to
Patrick McHenry
acting speaker pro tem.
McHenry.
A lot of people from business will know him. He's a pragmatic guy who's managed financial services, although the conservative, but he can't do much right now except for he really banged the gavel down yesterday. I almost thought he was bringing it down on Matt Gaetz's noggin when he gavelled out the thing. But no, Mitt Romney said it. There's a faction in both parties, but most certainly visibly in mine, that wants to perform and be seen as opposed to actually legislate and govern. And that's what led to the outcome you saw. He says today, that was yesterday.
Perform and be seen instead of legislating government. You could have just described entire Congress, both houses, by that. I don't mean to throw them all under the bus. There are some really good folks out there, well-intentioned, well-meaning, and that place our country and their responsibilities to the American people first. The problem is we don't hear from them. It's like that moderate voter. We don't hear from them. We hear from these extremes. I've not heard one person, as it looks like the increasingly more likely that we're going to have Donald Trump and Joe Biden on the ticket for the fall, 12 months from now. That's going to be your choice. Biden, Trump. I have not heard a single person from either side anywhere in this country to say, wow, Farr, isn't this going to be great? Isn't this the exact pair up you'd hope for? We can't lose. You can't make a bad choice. Isn't this? Not one.
Two vibrant,
out there,
ethical, strong leaders.
If you think that Biden, Trump is the ticket you wanted, please send me a note. I want to hear from you. I really do. I want to hear from anybody who thinks these are the two best choices we can have out of 335 million people.
No, I agree. And the fact too that we will have this rematch, likely it's going to resolve none of the political questions in this country. If you think things are going to be solved after a 2024 Biden-Trump rematch, I have news for you. It's likely only going to get worse.
Well, and candidates over the age of 80 years old will be celebrated with free tapioca night at assisted living complexes around the country, and maybe nowhere else, and actually not even there. Our senior citizen friends look at these choices and go, you don't want me as president of the United States, for God's sakes. No, you don't want these people. They're too old. Okay. And now we've got the Schrodinger speakership. Maybe he's alive inside the box. Maybe he's dead inside the box. I don't know. And I'm not sure who's willing to open the box to find out. Okay. So, Dan, as we look, the House is out now for a week. Senate is doing what they do, and we'll see. They're probably going to go out here shortly. Then what for the balance of the year? We've got this, we do have another shutdown vote pending with a non-speaker. They're going to try to elect a speaker. How does the House operate without a speaker? For how long? And has the balance of power shifted, or has it just been illuminated?
Look, I think the House, to answer your question operationally, it goes to like it was when we had the multiple votes for McCarthy in the beginning. It's like when your computer won't start up all the way and just keeps cycling. The House won't open until it has a speaker. So no business really is conducted. And the acting speaker, Patrick McHenry, is really there for his continuity of government roles and managing the Capitol complex. Beyond this, look, the top two you think about is it going to be Scalise, who of course is from Louisiana, and then Jim Jordan, who's also well known to those on right-wing media, but also one who's seen as a thorn in the side of the Biden administration. Now, I don't know the dynamics there. I think a lot of dust is still settling within the Republican conference, but those are the two you hear about most. I can't say too much about how we get towards this shutdown, this next shutdown, the new 45-day clock, one without knowing who the speaker is going to be. I don't think if you have a speaker, Jim Jordan, you have any prospects for a deal with the Senate, barring...
What about Scalise? Scalise is the name I'm hearing about.
Scalise you hear about too, and you hope that you can do it, but we also know that he's been battling blood cancer recently, and the prognosis has been well, but I think he has a discussion with family and doctors about whether he's able to do this, and he sounds like he wants to, but those are questions I think the conference is digesting. Both are not really known for their deal-making abilities. They're both known for being pretty good off partisans. Scalise at least has a sort of a sense of a better nature of the caucus, but then again, Jim Jordan has his pulse on the base. So those are two questions to iron out, but so I don't
Patrick
think
McHenry can't call the House into session.
He cannot to do business. He can only call them in to elect a new speaker.
That's the only thing he can. So, Dan, we're out of time, but certainly you have to wonder what they're thinking in Ukraine this morning, and what they're thinking in Russia, and what they're thinking in China, around the world, what the Iranians are thinking.
Sure.
Now,
Look,
they're
I
going to
think
listen a lot in a lot of these places to President Biden and what they're hearing from the executive branch, but do they have the ability to deliver if they can't get anything? I mean, all of a sudden, if our House of Representatives is completely hamstrung, I mean, it's a problem.
No, I think it is a problem. It shows a certain distractedness to the world in ways. I think, combined with President Biden's own struggles, it doesn't bode well for the image of U.S. leadership. At the same time, I will still point out to folks, as messy as it is, Kevin McCarthy lost his job in a vote of his colleagues on an open floor on live television. He was not disappeared from a Politburo meeting or carried away like Hu Jintao. Kevin McCarthy is not going to have to avoid balconies for the time being, nor is he going to have to worry about re-education through labor. So I think those are systems around the world. They may mock us right now, but I think we're still in a better boat.
Dan Mahaffee, Director of Policy at the Center for the Study of the Presidency and Congress, our senior political analyst on the FarrCast. Thank you, Dan.
Good to talk to you, Michael. Thank you.
Coming up, our great friend Bryn Talkington. Please stay with us.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. Thanks for joining us this week on the FarrCast. Please share us on your social media. And now, to introduce this week's special guest, here's your host, Michael Farr.
Welcome back, Series 7, Year 7 of the FarrCast. Here we go, our 7th year as we start up. And segment 3 covering Wall Street, Washington, and the world. As promised, ladies and gentlemen, the FarrCast fan favorite, Bryn Talkington, managing partner, Requisite Capital Management, 20 years of experience. Just one of the smartest folks we get to talk to, articulate and thoughtful, really thoughtful. A CNBC contributor on Fast Money, Halftime, and other areas in CNBC, Houston, Texas. Welcome back, Bryn.
Thanks for having me, Michael. Happy to be here.
We're glad you're here, joining us from New York City, from the fabulous. What's the name of the hotel?
The Ned Hotel.
The Ned Hotel. Now, don't storm the doors, folks. She will have checked out by the time this airs. I know everybody wants her autograph, and the groupies will be there. We're not giving the paparazzi a target here, Bryn. Hey,
Thank
Bryn, September was not a good month for markets. That we sort of expected. Yesterday, they seemed rocked a little bit. And our friend Art Cashin, I think, is calling for a short term. I added the short term part, bottom here in October for stocks. Maybe a short term bottom. That would make sense. All the other old guys are still calling for recession coming up. What do you think?
Hey, when Art talks, we listen.
That's
so he's great. So I think that just technically, and I think you have to look at technicals when you start to get a sell-off. The S&P is at 4,200 on the 200-day moving average. So we're basically there, right? We're very, very close. So I think bouncing off of that, getting close to that is going to be really important. The market is incredibly oversold. You know, this is as of Monday, so it got even worse yesterday. But as of Monday, about only 10% of stocks in the S&P were above their 200-day moving average. And so to me, the mother of all back the truck up is when you get the percent of stocks, when you get 20% or below or stocks are below their 200-day moving average, to me, that's a back the truck up moment. We're right now only about at 40% there, but I think from a short-term technical, that 50-day moving average, so few stocks are above that. That also, I think, coincides with us hitting the 200-day, having a short-term bounce.
You think it's a short-term back the truck up for a trade, or you can buy anything there for the next 10 years?
No, until you get the 200-day, until you get, I think, a washout, which ultimately, gravity is a constant force of nature in the stock market. And so I think you always get those opportunities, but tell me what the bond market's going to do, and then I'll tell you how big the opportunity is. I just think that the 50-day can be noisy, but I just think as a technical guide and as a washout, that 50-day is saying, hey, you could go buy, utilities were up yesterday, right? So those things have been washed out somewhat. And so I think from a bounce, you could go in there, but I wouldn't be setting up to all of a sudden go long high dividend stocks, go long utilities. I still think the rate pressure is going to be a game changer until something breaks. And that's really my main probability right now, is I think the likelihood or the probability that something breaks with this really fast rate rise gets higher and higher by the day. And I think that's an undercurrent of also why the market has been weak.
We had a very wonky discussion with Jim Iuorio in our first segment today, where he was talking about what rates do and how a yield curve goes out of inversion back to a normalized yield curve. And I had suggested that only happens one of two ways, because an inversion means that the 2-year is higher yielding than the 10-year. So one of two things has to happen. The 2-year has to drop below the 10-year, or the 10-year has to go higher above the 2-year. Now, can you monkey with both of them a little bit to get that to happen? Sure. But if the Fed says they're not moving on that short end, the only way you get out of inversion, if the Fed's not moving, is to move the 10-year higher. What do you think about that? And what do you think about a 5.5% 10-year? And I'm not suggesting that's what I'm seeing, but that's basically what it would take to get us to a normal yield curve.
Something breaks.
Something breaks.
Something breaks. You, Michael, you can't have 13 years of zero rates. We have massive leverage in the system, whether it's hedge fund leverage, whether it's central bank leverage, whether it's fiscal leverage, that everything has been levered to zero rates. You can't pop up in a year from the Fed going from 0 to now, let's say 5.25 on the 10-year, or 0 to 5.25 on Fed funds, and then you uninvert and just whistle past the graveyard. I just think there's too much leverage in the system. So ultimately, you can have as much conversation about can the economy handle or not handle. It's really about something coming, a long-term capital management, or another SVB coming in there saying, "Hey, uncle, we can't handle this."
Okay, so it sounds like you see a washout still in our future.
A washout of what? What do you mean? Like a washout in the market or the economy?
Oh, see, you're so good. I was going to let that hang. That washout in the markets, a sell-off in the markets caused by something breaking, because when things break, markets, of course, don't like things. They don't like surprises. The one thing they hate is to be surprised. The SVB, the long-term capital, those are surprises that hit the markets at vulnerable points, or hit the economy at a vulnerable point. And that's when the Fed typically has to step in. So, but stock prices suffer there. You get those washouts in share prices. So I'm hearing, I guess, you think one of those is still in our future?
I think as an asset allocator, we invest, client capital, and we're an asset allocator. And so we try to think in probabilities. And so I think the probability that something breaks as we've had such a fast rate rise, and I'm not talking about the Fed driven, I'm talking about the 10-year and the
Yes.
2-year. That's what I'm
Yes.
talking about. The probability that something breaks gets higher, and that should be in your equation. And so as you're thinking through asset allocation, and so as I hear people talking about earnings growth of 12% next year, of the economy strong, like I have a window and I can look at it outside the window and I can see exactly what they see as well. But I think what people miss and need to factor into their equation is that the leverage in the system creates unintended consequences when you have this move this fast. And I guarantee you the Fed is watching the 10-year.
Oh, absolutely. I think the odds of that 12% earnings increase for the S&P 500 next year are zero. Those are Farr's odds. Now, that isn't to say we won't have earnings in growth, but 12% doesn't seem realistic given the headwinds and the increasing rates and the cost of capital and everything else we're seeing. Those numbers just don't. That math doesn't work as I look at it. So I'm hearing kind of two things here that I always try and reconcile. Bryn, that you said is, okay, here we are. We started with this oversold position. We are moving into the neighborhood of a back up the truck buy, and yet there are the odds that something could break in perhaps the more distant future. Could happen faster, could happen anytime. That's how things break, of course, unexpectedly. How do I reconcile that as an investor? If I'm Fred and Ethel thinking about investing my 401k, I've got to know that Farr and Talkington are going to say, just stay invested and don't try and time the markets or worry about any of this because markets gyrate. But can you kind of give me the, wait a minute, how do I go from the back up the truck to the something's probably going to break?
Well, so just to clarify, the back up the truck is if the 200-day, right now you only have 40% of stocks are below their 200-day. If that number, it always happens, there will be a moment when you see 20% or fewer stocks are above their 200-day, that's when you start getting excited about a back up the truck. So we're not even close to that. We're still only at 40% of stocks are below their 200-day. So you need to see that come lower. And so that's just something, it doesn't happen very often, Michael,
right.
So it's only happened in March of 2020. It happened in 2018, in December of 2018. And so you get it every 4 or 5 years. It's kind of event driven. So just think for investors, just keep an eye on that. But I will promise when that happens, if it happens, something bad will have occurred. And so we all learn Finance 101. Everyone should buy low and sell high. But the reality, fund flows tell us time and time again, investors actually prefer to buy high and sell low.
They do.
And so that's how I square that up. And so I think, listen, if Art Cashin is saying, and that lines up with the 50-day, it lines up with, we're just about to touch the 200-day moving average on the S&P. If Art's like, hey, I think we can have a bounce here, I would go with with Art's been doing this for 6 decades. That lines up with common sense to me.
Yep, that makes sense. If we look at the S&P 500, where you have these 7 stocks that are up 80 some odd, almost 90% for the year, and the rest of the S&P isn't done anything for the year. As an asset allocator, do you still allocate new money to the S&P 500, feeling that you're still getting a diversified index? Mm-hmm. This is a very tough question I get a lot here lately, and I groan when people ask me because I hate that question. How are you answering it?
I think the S&P 500 is wonderful. So it is a meritocracy. And that's where market cap weighted indexes are meritocracies. The better, the more successful you are, the more wallet share you have. The worse you're doing, the less wallet share. And this is not new. And this is what I get frustrated because having a few stocks make up a large part of the return is the whole point of a market cap weighted index. It's happened so many times. And so I think it's disingenuous when people are plucking out X amount of stocks saying the S&P forward earnings or PE right now is 19, but if you take out 7 stocks, it's 14. That's not the way you can run money. And so from our perspective, the S&P is one of our largest weightings. Because guess what? The S&P continues to outperform the vast majority of active large cap managers that are actually trying to beat that index. Yes. And so I always appreciate a meritocracy in a company, a meritocracy in life. And so I think continue with the companies that have earned the right to be there. And guess what? If all of a sudden Apple or Microsoft become an Intel or an IBM,
Start what losing, a good way to say that. Yeah.
They start losing market share. Guess what? Another company that's actually doing better will slowly get higher and higher. So I just think the S&P is a wonderful investment. And I think plucking out, pulling in, trying to massage earnings is a fool's errand. And so I say buy the S&P, buy it and buy it again.
I think you are absolutely brilliant. I've always thought you were absolutely brilliant. Fabulous to get to talk to you. Final word to the nervous Fred and Ethel, the average investor, those 60-year-old investors who are saying, wait a minute, this really does matter to me now. And I'm looking at the year end and I'm looking at the speaker and I'm looking at all of these things around the world. What do you tell those clients?
We spend a lot of time looking for good strategies. We love ETFs. There's so many good strategies you can access. We love covered calls. So we in our portfolios look for strategies that can keep our clients invested, but also has some downside protection, some defensiveness, because ultimately, if we can't keep our clients, or if you as an investor can't stay in your seat long enough to earn the return of the asset class you've invested in, then that's the real failure. And so our job is to keep you in your seat, keep that seatbelt buckled, but we actually use it not just with words, we use strategies that can actually help investors stay through the cycle.
Absolutely brilliant. Thank you so much for being with us. Bryn Talkington is a managing partner of Requisite Capital Management, and has been in the business a long time. And you can hear why so many people want to hear what she has to say, the contributor on CNBC. Bryn, thanks so much.
Thanks, Michael. It's great to see you.
Great to see you too. Thank you. Ladies and gentlemen, that's it for another FarrCast as we cover Wall Street, Washington, and the world. We'll be back again next week with leading experts from around the country and around the world to bring you insights and help to understand what's going on and how it can be helpful to you as an investor. For Harry Jennings, our producer, all of us at Farr Miller and Washington Hightower Advisors, thanks for listening. Share us on your social media. I'll see you next week. I'm Michael Farr.
And that's a wrap for this episode of the FarrCast as we continue Season 7. Thanks for being with us this week and every week. We hope you enjoy the show as much as we enjoy making it for you. Thanks to our guests, Jim Iuorio, Dan Mahaffee, and special guests from Requisite Capital, Bryn Talkington. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly on all major podcast platforms, including Spotify, TuneIn, Apple Podcasts, and Google Podcasts. Please share with friends and colleagues. Take care, stay safe, stay healthy, and we'll be back with you next week with the FarrCast. Wall Street, Washington, and the world. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr, Miller & Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.